for those former founders in the room, you probably know it's like you have this like dream of crossing the finish line, but when you cross, you never think about what you're going to do after, and you start waking up in cold sweats.
Welcome to NYC Round, the podcast for curious startup founders.
Everybody knows what's a good growth deal. In seed, nobody knows. It's so hard.
In each episode, I dive deep into the learnings and mistakes made by the world-class investors and operators who have helped make the New York City tech ecosystem what it is today. For example, I feel like I've met 50 people starting AI dating coach apps today. This week is a special episode. I sat down with Ben Sun at Primary Ventures and Mar Hershenson at Pear VC in front of a live audience of LPs and VCs at Primary's annual event, NYC Summit. The three main topics I cover with Ben and Mar is how VC firms can differentiate in a crowded investing environment, how they can raise funds from LPs, and what are the type of startups that they are looking at today to help inform others that are looking to invest in an era when AI makes it easier than ever to build an app. I want to hear just a brief explanation of why each of you got started with your respective firms. Why did you launch it? You were successful entrepreneurs. What drove you to do that? Let's start with you, Mar.
All right. Well, thank you, Ben. You guys are the best in New York. Anyways, we are really close, the two firms, because we really don't compete with each other. So that's really nice. Anyways, story. Yes, I started Pear almost against my will, I would say. My partner, Pejman, had been an angel investor for many years, and he was my investor in my second company. So in 2009, he approached me with a 2-page business plan called Smart House. And he said, Mar, I am going to rent a house, and we are going to fill it up with founders. We're going to serve them Persian tea, and then we will back the best founders. And I want you to do it with me. And I was like, oh my God, this guy's insane. And for a long time, he would take me to see homes and in Palo Alto. And I said, no, this is not for me. So he changed. He's a good salesperson for anybody who knows him. So he changed the tactic. And he said, well, let's just start investing out of Coupa Cafe in Palo Alto. If anybody has been there, it's this iconic place. So we started together angel investing. I would go maybe an hour a week at the beginning, and after 3 months I was there every day from 9 a.m. till 5 p.m. Which is actually a really good way to meet people, because you're just there and I'm open for business and you can come pitch. But anyways, we started investing, and then we realized that, oh, we could actually do this together, and we have the same taste and so on. And we decided, finally I told him, okay, you win, we can go do this. I had no venture experience, which I know it's a really scary thing for LPs. And Pejman was a rug salesman, so he had no venture experience as an angel. We didn't know what we were doing, so the first thing I did is, I'm a good student, so I went to Amazon and I bought a book, which is How to Raise a Venture Fund, and I read it. Then I learned the lingo, and the first thing we did is put a deck together. So we used this thing. I don't know if anybody remembers something called Prezi. Did anybody use Prezi? Great. Well, we did that. We would send it to LPs, and the answer was, it's interesting, because it was really interesting to get it in that format. But anyways, we were very fortunate to get a few of my old investors to tell me, oh, you don't know what you're doing, let me tell you how to do it. And that's how, we got in business.
Yeah, so not dissimilar to Mar. I mean, I was born and raised in New York, and then became a founder when I was 22. I started an early social networking company, bootstrapped in my apartment for 2 years here in New York, ran it for altogether 12 years, sold that company in about 2008. Had about 130 employees here, survived the dot-com bust, became profitable. It was a terribly hard ride. When I sold my company, I had Bear Stearns as my bankers. While we're in merger docs to get acquired, Bear Stearns goes bankrupt. So it was just all these things. So I sell the company, I make some money from it. Not a ton, but definitely hey, create flexibility on what I do next. Financial crisis hit, took a year off, and did some soul searching. And I was like, what do I want to do next? For those former founders in the room, you probably know, it's like you have this dream of crossing the finish line, but when you cross, you never think about what you're going to do after, and you start waking up in cold sweats. And I just realized like, all right, when am I, there's all these existential questions. And I was like, I want to work with founders. Like my journey was really hard. My investors, VCs sucked. And a lot of my founder friends felt the same. And I was like, you know what, I want to help them in their journeys. And I think if I am more hands-on, I'll become a better investor for it. And so I carved out, a couple $1 million I made, and I said, I'm going to invest in myself and start my own thing. And so I went out on my own, just investing personally, and did that for the next 4 or 5 years, did 10 deals. Often I was on the board. Sometimes I helped start the company. And fortunately, one of them was this company, Coupang, which is now a $40 billion market cap company. It's publicly traded. I'm on the board still. Bomb I met here playing basketball at Stuyvesant High School. So, and then I started developing a thesis of like New York. I knew Brad. Him and I were friends, and he started asking me he's like, Brad was thinking about his next chapter. He's like, hey, do you want to start a firm together? And I said no, like 3 or 4, maybe 5 times. And then he kept on saying, why? Yeah, maybe 6. And every time he asked me like, why? And I have some reason, and he'd say, look, we can tackle it this way, and let's do it this way. And I think I started really craving that partnership, and I was like, wow, this is kind of a lonely job without it. And plus, I knew I couldn't scale as a one-man show, and I was like, well, let me see if I can build a fund in a firm. And so him and I co-founded Primary almost 10 years ago, and it's been a great ride.
Maybe I can say one thing. I actually think what you said, it's, Brad is the Mar of Pear, and you are the Peshman of Pear, because it's the same dynamic, but I think it really works to have these partnerships that are so strong and push-pull.
Yeah, and people know us. I mean, Brad and I are very different. I'm sure you're in
very different.
Very different. And Brad and I talk about it all the time. Like, the one thing that's not different is the why.
Yeah,
why.
the values.
The values. The
That's
why.
right.
And when we got together, we established our core values. We talk about the why all the time. The how and what differ all the time.
Totally.
But that's so healthy, right? Like, we're pushing and challenging
And it's
each other.
kind of the same advice we give to founders, right? If you are getting together, make sure you have the same values.
Totally.
It's the same.
Yeah, we did that the whole exercise, and
Yes.
let's talk about that. Yeah, so.
Makes sense. Now the hard part of the question. If you were starting Primary and Pear today, what would you do differently? What does differentiation mean today as a GP? And what wasn't considered table stakes in 2015, 2014 that now is today? Before we hear their answer, I just want to take a moment to thank everybody for being a part of the NYC round journey since we got started earlier this year. For more founder and investor-driven content, like and subscribe. Now back to the interview.
It's a really different market. I think Brad and I, when we first entered, and it was a long journey, and it's going to be really fun to have Chris Dubos look at our old deck, which is part of this exercise today. We realized that we ended up with this strategy through iteration to say we actually are going to just focus on New York. It actually wasn't we were kind of saying it, but not really laying putting the flag in the ground on it. And then we said, okay, we're going to focus on New York. And I think that was absolutely the right choice because there were so few firms here that could lead seed rounds that I think Brad and I then said, look, we're going to see a lot of deals and good quality deals because there's not many firms here. And the strategy, we literally did an offsite when we did it's like a whiteboard, like, okay, how do we make sure we see good deals? We had what we called hitch your wagon strategy. There were like a couple, like handful of firms that were kind of more well-known because they've been around longer. So, First Round was here, Graycroft was here, Lair was here. And we just basically said, okay, who are the 10 firms that kind of everyone goes to now? And let's just everyone's collaborative. Let's do regular check-ins to make sure we're in their deal flow. And that's what we did. I think that's really different now. There's so many VCs, so many seed stage investors, the multi-stage guys in it. The one thing I would do now if I started that is you probably have to come out of the gate with a sourcing edge. And if you don't have a really robust way to win on deal flow, I think it becomes very challenging quickly.
Yeah, that makes sense. Yeah, if you were going to say we started in Arkansas, I might not believe that. But yeah. How about you, Mar?
Yeah, I'd be thinking pretty similar. Ultimately our job is a sales job. We are selling the opportunity to work with us, but we're selling money. And you have to convince the founders that it's worth to take your money. And it's very competitive, as you know. I mean, it's just not the seed funds. I had a bunch of conversations here today. about the multi-stage funds, right? It's very competitive. So we're always thinking, why us, right? And that, I don't think it ends fund one, fund two. Its job is exhausting. We're constantly finding product market fit because the market changes under you. We started with a very simple business plan. We said Pashman wanted his house, and I said, let's do it in Palo Alto. Let's get Stanford students. So for a few years, there was a lot of alpha, and it was really easy to get that population, but there's no IP in venture. People copy your sourcing all the time, right? There's no differentiation. So you constantly have to figure out, where's the alpha? Where am I going to get that? How do I win? I mean, you guys have a platform team. We have a platform team. Yeah. I actually think, people always say, the anti-platform people, they exist. They will say, but you can't really help a bad company. That is not the job of the platform team, right? Saying, honestly, I consider them part of our sourcing. They help you win. I mean, it's part of one of the reasons that we think they're crucial to our strategy, right? And that was not something we did day one. So anyways, it's not a question just for first-time founders. It's anybody who has a fund has to be thinking about why me, why now, right?
Yeah, there's a real strong nugget there in the audience, like getting very segmented. Like there's a ton of opportunity today if you really laser focus there and try to get, as you said, the alpha there before anybody else does.
And it is a little bit like our companies. If we have a company, I know that the classic advice is find a wedge, find your ICP, go there, and then once you are successful somewhere, you gain the right to take the rest. And I think, it was easier for us because there were just not that many people competing. So you have that first mover advantage. Right. But that's the strategy, no matter what business you are.
Mar, I'm going to start with you on this first one. Is there a mistake that you made in the early years that still keeps you up at night today?
Oh my God, missing companies. That's my biggest mistake. I have,
Let's dig into that. What were the reasons you missed something? What were the reasons why you passed?
Don't want to cry. It's really, this is a brutal business because it really is the difference between a great fund and an okay fund is one company, right? Or two companies. And sometimes you have the opportunity to work with somebody and you don't give them an offer. And the reason is because you think you're smarter than them, and the best founders know more than any of us in this room, period. I'm just fully convinced of that, and I have to constantly check my ego and remind myself that there are better people out there, and that's my job, to find those people and recognize them. I think everybody, I'm sure, I'm guessing Ben did miss something too. Every time it's been about, the market this and that, the competitor this and this, the pricing this and that, and you go back and, this founder had a vision, knew something I didn't, and I didn't recognize it at the time, right? This job is it's a little bit like selling a consumer product. You have to be really good at people. So psychology, anthropology, signs that, tell you who is a good founder. It's kind of a craft, and that's, I aspire to be really good at it. So it's a journey, I would say. I'll just say one thing. I actually heard this, maybe a nugget for people that write it down, but it's not correlated. It's not causal. But Pashman told me, did you know that the founders of Harvey run a mile in under 5 minutes? I'm like, no, I didn't. That's why they invested in that. But it's a sign, like some people are that obsessed.
Gotcha. Ben?
I would definitely echo Mar on definitely the stuff that you did, one of the things you missed. I'd probably say that a second for me would be, and maybe that's also because I was so new at running a venture firm. Before I was just like, I'm an angel, and I don't know if I had really that much of a strategy. And then when you're running a fund, I think you have to think more strategically. And I think at the beginning, you tend not to be first principles thinkers, and you just take at surface value what everyone says you should do, you just do. So you'd ask another manager, how do you do reserves? And they say, 1-to-1, right? And it was kind of the common answer. And I was like, that's what we should do. All right. And then you suddenly actually start working a fund, and you're like, oh man, this actually was kind of a bad idea because we just invested in some company, and and we're supposed to put in a lot more money next round, but then like the round gets crowded, the price goes up dramatically, and we're like, shouldn't we put more money there in the beginning? And so there's just a level, there's this first principles thinking when someone just told me that, I should have asked why. Like, why do that? And keep on asking why. They might say, oh, you want to double down your best winners. I'm like, okay, but why? Because the price was cheaper 1/4 the price in the earlier round. I can be wrong more often, and I could have bought it at a cheaper price. Like, why shouldn't I have done that? Like, I should have just pressed and pressed and pressed. And I think we, in mid-first fund, Brad and I started being more first principles thinkers and seeing how the fund was developing. We're like, oh, we're kind of fucking this up. And then we started like pivoting and changing a lot of our strategy. And I think that actually like saved us. But like, I think we got lucky that we came up with that. We could have like probably killed that first fund, which meant the fund would be done.
Makes sense. Shifting gears over to fundraising, LP fundraising under ordinary circumstances is really challenging, but especially right now in the current macro environment. What's on each of your cheat sheets for GPs that are going out right now to fundraise from LPs? Ben?
Definitely, I would tell you, if you start doing deals with other well-respected managers, that you should ask for intros, for sure. I've heard from LPs like a great signal for them is that a manager they really respect, he says, hey, you should really talk to Ben in primary. I think he's great. Is a big deal. And we saw that. Like I constantly worked like, oh, I'm on the board with blah, blah, blah. Made sure like we're doing really good work. We built a good relationship. And I'd say, hey, do you mind introducing me a couple of your LPs? And obviously they've been successful already. And they're like, absolutely. So I'd say that's like was a big one for us.
I would say that, the main question is the same questions for the founders is the why me. And I think the LPs are looking at all these folks that at a high level, they look the same. So they're like, I'm an operator, I have a great network, and my angel portfolio is amazing. And they just look the same. They don't know who's better, why you. So you have to be so crisp at the why me. I actually try to help a lot of early emergent managers with their fundraising. And I don't know, somebody told me, I think my partner Warren said I'm kind but nice, or something like that. What did you say? But not nice. I'm kind but not nice. So I'm very direct. So I almost always say, this is like the same deck I saw. And you really have to be very clear the why me, right? I think it could be the vertical, the network, and know-how. And it's the same question about why a founder should take money from you. It's exactly the same question. And because it's so competitive, it is not enough to say I have a great network and whatever. I know Ben, although that's very good, it's not enough. You have to be very clearly articulate that. And if you can't, then maybe it's like a founder and maybe you shouldn't do it. That's kind of what the bottom line is, because the LP is looking, they're asset allocators. It took me a long time to figure out their business, but now I sit in an endowment and I'm like, oh, I get it, But they're asset allocators and they're like, okay, there's this piece of the market I don't have, and I'm gonna go look for managers that are the best in that sector of the market. Many people say no, but it's not because they don't like you or your track record, it's because they have that box filled up, right? So your first job is, do you need people in that box? Okay, and that's why I'm good for that box. And even if you have primary or pair, you really want to have me because this is how I work in that, with them. That's how you have to reverse the pitch, right? It's kind of the one-on-one on sales. Like, what's the other side looking for? And that's what I sell. I don't sell my product. I sell whatever they need,
And just to add on Mar's point about being differentiated and combining that with like talking to or getting referrals from other GPs, like you have to tell those GPs that are referring to you, like let them understand your strategy, let them understand you're differentiated. So I'll give you a great example. Like I've known Josh Kushner from Thrive since the very first fund. I remember meeting him in the park, and it was like a windy, bad day. Chris Pike was in it with him. Chris was like 22 or 21. It was a long time ago. Josh and I just got together recently, and I gave him like a full pitch. And I was also asking for advice. I was like, hey man, like anything else I should be thinking about, blah, blah. He gave me some great insights. But I was like, that's really important because if other LPs talk to Josh, like hopefully he thinks highly of me, but then he can also say, hey, Molly, I think Ben is smart and he's had a pretty good track record. He's like, hey, I think what he's doing is actually really good. And I think that was important for me to make sure, like, let's make sure those nodes that LPs are looking for kind of have a really aligned understanding.
Makes sense. A bit of a side question based on the responses. Any trends that you're noticing in the type of LP, asset providers? Are corporate venture arms still active today, like family offices? Where are you seeing trends in terms of the concentration of LPs investing in firms?
I haven't talked to them in a year or a half or two, so I don't know. But I would say that the market, maybe it's a side question. I mean, gonna be like the debate. Let me answer a side question, which is, the fundraising environment has changed a lot in the last 10 years. I think when we started, the multi-stage funds were not raising billions of dollars, and the LPs were really proud to be investors in such and such firm. But right now, and these LPs exist. Some family office starts, they're new, they just got a bunch of money, whatever, $10 billion, let's say. They can basically call the IR people at Andreessen, whatever, Founders Fund, whatever, all of them, and they'll get an allocation. And nobody's getting fired for doing that. And they know that the returns are whatever they are because a lot of the dollars are not going into seed. But when 80% of your budget is with a multi-stage, then it's much harder for seed people to go out and fundraise, right? Because then you're fundraising from that. And remember, they're asset allocators. So their board has told them, this is how much you can spend in venture. This is your budget. And then they have to allocate it. And if 80% is going to multi-stage, and it is going to multi-stage, then the other 20% is much smaller than what it was in 2013. So it's tougher. I think the family offices get more loose. Like I think the endowments are more formal, and the family office is more goosey loose, and they may be more aggressive on privates. And I think in some of them there is more flexibility. So I think it's perhaps an easier entry point than going after the more formal people when you get started.
Yeah, the only thing I would really add to that, I definitely handle most of the kind of LP fundraising pipeline. So have conversations all the time. Probably last year I spoke to like 100 LPs, or potential LPs. I would say the good news in the market, and there's some LPs in the room, is that people are definitely kind of course correcting from an asset allocation perspective, like, hey, they invested in a bunch of multi-stage growth funds, and I feel like there's a lot of guys looking for early. So I think that's a really good sign for more emerging managers, smaller funds. So I'm definitely seeing more of that across the board, like family offices, endowments, foundations, across the board. There's people that really understand the asset class. Like when you hear like, hey, we follow like an endowment model, like they are sophisticated. They plan to underwrite you, not just for this fund, but for like at least the next 3. Then there's the folks that are like maybe tourists in it, like, oh, I kind of stayed out of venture, it was heated, now it seems like corrected, maybe I should jump in. I get a little bit nervous of folks like that because it's like they're dipping the toe, like they can change their mind. There's a family office that I know that came in their last fund that they even told me like for this upcoming fund, like, we kind of switching our strategy. And I'm like, yeah, you just started venture for the first time. That's a red flag. So I would say there's a kind of mixed bag, but I still say the appetite for venture still is out there. I think running a big growth fund is really hard. I think there's interest in managers. There's just a lot of early stage managers. So getting to Mar's point, like if you have a really differentiated story, I think you can get a fund done for sure. But make sure you have a like why me story.
That makes sense. Is there any common piece of advice that you think, GPs in the room here, others out there get commonly that you think is the most like misinformed piece of advice?
Misinformed? No.
The only thing I would say is like, again, when you talk to other managers and just be first principles thinkers on stuff, like just because there was a certain way of doing things, it doesn't mean it's right. And I would actually push managers to think differently in order to find alpha.
I think that's the thing about playbooks is like they're playbooks, but they're tried.
Yeah, and you should learn from managers on best practices and borrow, steal, but then try to also figure out your differentiation. Don't be afraid to experiment with something new. We've done incubation as a firm from the very first fund. And I remember at the very beginning, it was like, what are you doing? And we almost had to like tuck it in and not really tell anybody about it because LPs were like, what do you, like, what's this thing? Like, I want to invest in a venture firm, not like some incubation thing. And so we incubated 2 companies. They did really well. And so by the second fund, we're like, hey, we put points on the board. We think this is going to be part of our strategy. And so I think we could have said, hey, let's not do it because LPs might be too scared of it. And I think we just said, look, we think it's the right thing. Let's go for it. And I think for a lot of good managers, unless you're thinking, significantly differently and trying different things and iterating and learning, I think it's just a missed opportunity. I think you really, to differentiate, you have to take risks yourself.
There could be scenarios where LPs don't get it initially. That's what you're saying.
They definitely didn't get a lot of stuff we did, including incubation. It was really tough. Now, 30% of the deals we do are going to be incubation, and very much LPs are coming to us and saying, a big reason we want to invest in you guys is because of your incubation. It's like that to them is like a source of alpha, and they're like, okay, I can go. I'm like, this is a reason for me on the why me.
That makes sense. One final question is, Ben, something we talked about in our interview was primary sort of underwrites from seed stage to Series A. Who will make it to Series A? I'm curious for both of you, like in this moment, it feels like it's easier than ever to spin up a startup. How do you pick the winners? How do you evaluate what success looks like today? And how do you evaluate who's going to make it to Series A? For example, I feel like I've met 50 people starting AI dating coach apps today. I mean, like, how do you pick the winners today?
Yeah, so we've always, I remember listening to some podcasts, and one guy says, that seed investing is almost like an origination business, right? Like, our job is to like find these companies super early, originate those deals, and then feed them to like the Series A and downstream investors, right? And so if you're in the origination business, you should know who you're going to sell to in the next round. And the difference in the market when Brad and I first started, when the ecosystem was a lot smaller, right? Smaller funds, no one were really specialists. It was less complicated. Everyone was kind of generalists. You can basically, hey, let me just sell you why this company is good. Now you have downstream investors that are a lot more sophisticated, much more focused on the sector, have developed a real thesis. So if you're now focused on fintech, you better know what the fintech Series A, B, C guys, because it's all connected. And so, Emily Mann joined us from Redpoint. She worked at, growth at Redpoint. She was the customer of our origination. And so she joined us. She's like, hey, I know she's going to have that lens of like, when I tell you we got to get 80% of our seed bets to an A, like she originally, like right away knows what to underwrite. And she'll say, hey, these guys don't like lending business for this reason. They don't like this, like this is fail. Like she just has that perception. And that makes him a better underwriter. Now, you can always look at deals that are completely out of the box, like whatever people call it, non-consensus, non-obvious. Problem with doing non-obvious deals, you have to be non-obvious and right? We're not shy away from that, but then we look at those deals and say, you better be if you do non-obvious, the numbers better be popping off the page. Because if you're going out to a market to sell some funky thing, and we did it, we achieved a bunch of stuff that no one was looking for, but we were like, the numbers were popping off the page. And so we think about it that way in terms of like making sure our investors are thinking about that graduation rate and thinking about that downstream origination play.
Yeah, I feel that this is the most popular question we get also from founders. It's a really hard question because there's so much craft in this business about choosing that company. That's what's great about, in growth, everybody knows what's a good growth deal. In seed, nobody knows what's a good seed invest. It's so hard, right? And even the things that, it's interesting, but I find that even the hottest deals with the largest rounds are actually the ones that fail at seed because there's just the signal is so subtle, right? So I am very founder driven, and I actually try to really get to know the founder deeply before we make an investment. We don't have incubation, we have acceleration. So I think we're more founder the stage is the same, it's formation stage. So the idea, 50% of our companies change idea. That's very crazy, right? I mean, it's kind of nuts. So I know that I'm not quite investing in that idea, but I'm investing in that founder. And I'm trying to judge when they explain what they're doing, their dating app, how they talk about their idea and how they talk about the future and what is dating in 10 years. And I think very few people have that skill. Very, very, very few people. I tell this story because, again, it shows how VCs don't know anything and how founders are amazing. But when we first met Tony at DoorDash, Benjamin and I were just started, and I was with my notebook with my questions, and I'm like, well, how big is the pizza delivery business in the US? And Tony looked at me and said, I'm not building a food delivery business, I'm building a last mile delivery business. And that's type of founder it's not common when you get somebody telling you that. It's just not common. I bet you the same product, the same thing, dating apps, there's a power law on how that founder talks about what they're building. And I think the craft of our industry is being ready to receive those signals. And I don't think it's super easy. So that's why we make so many mistakes.
Makes sense. Well, thank you both, and thanks to everybody here for attending the session.